Hello everyone, welcome back to the J22 Report. I'm your host, Johnnie Market. You all know the drill. Hit the like button, subscribe if you already haven't. And I just wanted to get into a quick video of basically reiterating yesterday, but just short, quick facts, because I did a lot of things and I did a lot of thinking out loud, but I can see where people could get lost in it. So first thing, let's examine the bull markets post the United States leaving the gold standard. So in 1968 through 1980, the S&P 500 in 1968 was $923. In 1980, it was $384. That's a declining stock market. That is one thing that is needed in this fiat currency system. A long-term declining stock market. B, oil OPEC embargo. That was the Iranian hostage crisis also. So geopolitical crisis. There was the oil OPEC embargo, which caused shortages, and the Iranian hostage crisis late in the 1970s. C, inflation in 1968 was at 4%. In 1980, it was 13%. You had a steady incline of inflation. The Fed's funds rates, for the most part, generally hovered around 4%. In 1975, there was a brief spike, and that caused the mid-correction. There was a famous correction in the gold bull market in the 1970s, where gold went from 200 to 100, and that spike in interest rates caused it. And then what also happened was GDP growth in the 1960s was average around 4.5%. In the 1970s, 3.5%. So we had a declining real economy. And I didn't see what the average unemployment rate was, but the unemployment rate was a creature of the Fed. It didn't become that big until Bernanke said he's going to base monetary policy off that. So, but if you look at it, we have a declining economy. So those were all the things it had. And then in 2000 to 2011, the S&P in the year 2000 was around $2,496. And in 2011, it was $1,681. So you can see another declining stock bear market over time. In 2000 through 2011, we had 9/11, the Afghan War, and the Iraq War, geopolitical crises. And then inflation was around 3 to 2.9%, which isn't great, but you have to consider the Fed funds rate went from 6.2% and basically averaged around 1.5%. There was a brief time of raising in 2006 through 2008, but then it went down again to almost zero. And so that was and then the other thing is GDP growth rate went from the average of 3.2% in the 1990s to 1.9% in the 2000s. So you can see we had a declining real economy. So if you look at those are what the factors. Now, a lot of people will say gold is a hedge against, people lose faith in governments, which is the dumbest analysis that I've ever heard. Some people say it's a decline against real rates, prolonged. But that's true, but something needs to prolong these real rates. And you can see geopolitical tensions. That makes the U.S. actively involved. They need to finance their geopolitical crises, meaning their responses. And not only that, declining economy. They use fiscal and monetary stimulus to juice up the economy. So that is what causes this. So now if you look at what we're doing now, why I think we're on the cusp of a bull market, not quite yet, but look, 2021, the high in the S&P was 4,766. Now it's about a year and a half later, 4,133. So you start to see that little decline in the stock market. Now it could go up and make one more all-time high, but I think the economy is so bad that I don't think they'll be able to just juice up the market anymore. There's too much irresponsibility in the financial side of things. Then geopolitical tensions. last decade, it was all the Middle East. There's new ones: Russia and Ukraine, China and Taiwan, and then Saudi Arabia is breaking its alliance with U.S. The petrodollar, that's many things. I don't have time for that. Inflation now went from almost zero last decade to 6 to 7%. Right now, the Fed funds rates is roughly 4.6%, maybe 5.5. I don't know the exact number, but they're expected to even stop hiking rates this year or soon. So, and I personally think they're going to reverse course. So you can see we have negative real rates now. And then GDP growth last decade was around 2.3%. Now it's on average 1.9. So, and not only that, so if you look at this, not only that, I think GDP is much more manufactured and fudged now than it was even in 2000, 2011. They even changed the formula in 2013. So it's probably much lower if you had to use the same measuring sticks as 1968 through 80 and 2000 through 2011. So if you look at those quick things, all those catalysts from the 68 to 80 bull market, 2000 to 2011 bull market, they're coming now. They're on the horizon. They haven't fully materialized, but they are coming. So anyway, if you like this video, hit that like button, subscribe if you already haven't, and I'll see you next video.